So the next part of this module is how can you profit from crypto? So lucky we've just had that session to sort of clear the mind, because this next part we're going to be going through quite a bit. Not to scare you, but just so you know what options are available in terms of earning profits in the crypto space. So so the first method is hodling, or buying and holding, right? The term hodl came from like hold on for dear life, and it's also like an amalgamation of the Game of Thrones hodor, like hold the door kind of thing. It's basically the very basic thing that people did when they were investing. It's like just buy Bitcoin, hold on for dear life, and hope that the roller coaster, even though it goes up and down, like eventually goes to the moon kind of thing. That was the the terminology being used. And a lot of people think that, okay, I'll just buy Bitcoin or whatever asset, and it's going to be smooth sailing. I don't have to do anything. I don't have to be active or anything like that, just like any other investment. But the reality of things is that when you hold something long term, it ebbs and flows, and you can have these rises and falls and that sort of thing. But in general, if you're on a trajectory going up, then you do end up being able to make profit in this space from just holding your nuts like a squirrel.
Yeah. And this is why we call the mentality part 80% mentality, 20% technical analysis, 20% technically knowing what's happening. Because when you scroll out, and we're going to see this tomorrow when we look a bit more at trading side of it, but when you scroll out, and we're going to use Bitcoin chart for example, because it's been going for 10 years, the trajectory is this. If you look at the monthly charts, for example, or the yearly charts, it's always heading up in an upwards direction, and people get so caught up in the daily or the 4-hourly chart. Oh no, there's been a huge drop and it's gone back up and it's gone back down. Like that second picture shows, there's definitely ebbs and flows, but the whole idea about that mentality of being able to hold on, one of the hardest things that I've had to do, hand on my heart, is holding a portion of crypto that I have in an account. And like I've physically had to like remove the temptation of that treasure, and it's in another house of a trusted person that I have, because I know that myself, it would come to a time where I'm like, oh, I can trade that and earn more, or I'm going to get out of the markets now, or whatever it may be. And it's it's so difficult. It's, you've got to have that mentality and remove, and we'll touch on this a bit later, but remove those temptations.
Again, this is a real novice question, but could somebody just buy, I don't know, $1,000 or whatever worth of crypto today and hold it for the next 20 years and then
Absolutely.
expect just like, and not put anything additional and then expect a massive return after those 20 years? Is that what the thinking is?
So the key part there is going to be how many years. Are we going to see a top for this in 2 years? Is it going to be 5? Is it going to be 10? Is it going to be 20? The whole idea of the trajectory and the scale based on the last 11 years of data is this. But like with everything, and we will touch more on this tomorrow, there's 4-year market cycles that happen quite often in trading and in markets in general. And we are currently heading into a bull period of 4 years. And in the last 2 4-year cycles of Bitcoin, because we've only got 11 years.
Is everyone there, or is it just me that's frozen?
In theory. Sorry, bro.
Oh, sorry, my internet froze. It's all right.
Oh, that's okay. I think can everyone still hear us? I hope.
Yeah.
Yes.
Yeah. Okay. Cool. Awesome. Yeah. Sorry. I think we just think there might have been a freeze there for a second. But so the $1 million question, Linda, is that top for Bitcoin and crypto going to come in the next 12 to 18 months after this next projected bull run? Will it be in the next 4-year cycle or the following 4-year cycle? It all comes down to your risk to reward ratio based on the last 11 years of data. that should be what's happened. And based on the behavior of massive institutions storing Bitcoin and using it as a store of value and treating it like digital gold, that's the projection and the idea based on the data we have. But once again, prior results don't always guarantee future predictions. So is there, in Kevin and my humble opinion, based on the years that we've been in crypto and Bitcoin, our humble prediction is that yes, it is going to go up in value. Where's it stop though? You know what I mean? Where does it stop? Does it get to a point where it goes that high up in value that everyone decides that this is awesome and we're going to sell it, right? And then it has this massive drop, and then it loses momentum, and then it doesn't quite ever get anywhere near that extra high. Look, what happens? You know what I mean? This is the things that we don't know. Is there going to be like the potential which people are talking about, like another major crash that could happen in the banking system? Like there's multiple countries that are suffering severely from COVID and their banking systems are collapsing and all this crazy stuff's happening. You know, in a kind of morbid kind of way, this is the perfect storm for Bitcoin and crypto, right? For the price of its intrinsic value to rise, and therefore that's why these massive institutions are jumping on board. But yeah, is the golden question to take it out in 20 years or 2 years? No one knows. But the general direction based on the data we have is this way.
Yeah, and tomorrow, just add on that, tomorrow we'll share with you some tools that you can use to sort of make projections and predictions yourself to sort of, you know,
Yeah.
if you imagine this is the Bitcoin chart and, you know, this is zero, this is the price moving up and over here, oh, sorry, you can see, yeah, this is zero, that's the price moving up, and over here is the timeline. You know, if your horizon is simply looking at this point here at the bottom, or this point here, yeah, you could say, like, if you're cashing out of the market when it's at the bottom, then, you know, your perspective at that time could be, oh no, Bitcoin's crashed and this is a bad thing. Like for anyone who bought in at, say, at the peak in 2017, imagine if you bought Bitcoin at 18,000 back then. You know, in 2018, when the market pretty much corrected itself, a lot of people were saying, "Oh, Bitcoin's dead, and that's it. Like this is so bad. Crypto's so terrible." And then now, just, you know, 2-3 years later, we're back at that same level and about to cross it again. You know, there's potential for it to cross. So it really just depends on how long you can hold on for dear life and expect the investment to go up.
And so Kevin and I have kind of got our own theory, and a lot of traders have this theory that we all believe that Bitcoin and crypto is going up, but we kind of have a backup plan, which is that if Bitcoin falls out of the sky or crypto falls out of the sky or something crazy happens, we have the ability now as traders to short the market and make just as much money if it drops from $20,000 to $7, right?
Of spread betting,
and
or something?
No, it's basically just short. Oh, sorry, you go, Kev.
Yeah. Sorry, I was just shorting the market is basically selling at the top and then buying back down at the bottom when the market's moving down.
Buying back in when it drops.
Yeah. It's possible to make.
Sorry, yeah, I should have explained what shorting was. Yeah, so when you go long in a market, it means that you're based on your analysis, you believe the market's going to go up. But when you go short, it means that based on your analysis of how the markets are, you believe it's going to go down, right? So a trader, it makes no difference to me or Kevin whether Bitcoin goes down to $2,000 next week from 20,000, or if it goes to $100,000 next week from 20,000, because based on our analysis of the charts, we'll be able to predict based on the art of probability whether the market's going up, and we will trade the long as it goes up, or we'll trade the short as it goes down. So we make money no matter where the market goes up and down. But as a hodler and someone who holds the coins, if Bitcoin has a massive correction, which has done plenty of times in the past and had a massive 50%, 60% correction from $20,000 back to $8,000, that takes massive, I'm going to use the term balls of steel to hold on, right? as you see your price of your asset halve, you're holding on for dear life, thinking, oh my God, you're entering into capitulation stage, right? Where as a trader, we're just like, oh well, I've just made money as it's dropped down, and then I'm just going to make money as it bounces back up again. So we'll touch more on trading. We probably shouldn't have spoken, but a lot of our analysis, we go back to that because of the advantages of doing it. But there are definitely people who have bought Bitcoin and are just holding it. Like I said before, I got cut off earlier. My inactive investor friends who bought $3,000 worth of crypto back in 2017 and then are messaging me now because they hear in the news that Bitcoin's booming again. Oh, hey man, can you help me? I bought $3,000, but I actually don't even remember where it is or what I've done with it. And that's where I was kind of like, dude, that's $3,000. That's a lot of money. Would you just take $3,000 and just go, oh, cool, well, I hope I get more of this. I'm just going to leave it in the front garden, and hopefully it's there in 3 years' time. So that's unless I don't feel anyone on this call or anyone listening back to it and in our community is like that, where they'd be so careless with their money. But that's the kind of thing. If you're a holder and you're conscious with your money, you have to have massive balls of steel to hang on to those corrections, because those corrections can be very violent. And if you're watching the market every week or every day, you're like, oh my God, I was just looking at this and now it's $10,000. Yesterday it was $20,000. This happens, right? But if you look at the monthly chart of Bitcoin, it's just a blip in the monthly chart. It's still heading up in an upwards direction. It just had a massive correction for a week and then bounced straight back up. So I hope that all kind of makes sense. This is all going to make more sense as we start looking at charts tomorrow.
Yeah. Maybe I can share, because I have gone through the whole loop that's on the lower picture here. I bought in at, I think, $8,000 in 2017. I went all the way to the top. I had a thought to sell it at 19. I didn't sell it, and then I went all the way back down again through 3,000, and then up at 14,000, and then down again to 3,000, and then up again. So it took 2 cycles, like these 2 ups and downs, before I had actually worked through all of the emotions that I had around it. The fear, the regret, the self-judgment, the doubt, and really like feelings of being like, sick to my gut for all the mistakes. But the amount of learning coming through, working through these cycles like that, and the thoughts, like I can disclose, Linda is a very professional person when it comes to working with the mind as well. So she knows what I'm talking about. But yeah, that's been my journey so far.
So the moral of the story is Kjartan has massive balls.
At least they grew.
And if he didn't have them before, in his 3 years experience with Bitcoin, he now has massive balls of steel.
I think, there's a difference between an investing mindset and a trading mindset. And that, again, we'll touch more on that tomorrow, because, when you invest in something, you've got hopes and expectations that something's going to grow. That's what you want it to do. Whereas when you're trading, you almost detach yourself from the emotions and just stick to your technical analysis and the trade plans that you set in motion. And you have to come to terms with the risk that like it's inevitable. You are going to lose something, but you're also going to gain something, and it's just a game of probabilities. And as Troy said, it doesn't matter. Like during this call, I've got a little ticker on my screen that shows the price of Bitcoin moving up and down, and it's bounced up and down like $100, $200 just within this call. And if you imagine yourself like being a kind of erratic trader trading, minute to minute, you might be like, oh my God, it's gone up 100. Oh no, it's gone down 200. Oh my God, it's gone up 100. And like that's just no way to live, for me. Whereas, what we'll go through is like ways to sort of, pull out and expand your horizon. You just go, yeah, cool, whatever. It's going up and down.
That's like
So,
jumping on the scale 10 times a day. It just doesn't work. It doesn't work. Like, don't do that.
That's a
Or at least
perfect
that's my view.
So yeah,
Perfect.
that's only the first method to profit. Profiting for this strategy is just buy low, wait for it, and sell high.
But this is the crazy thing, right? And that makes complete sense what Kevin's just said. But where is the low for Bitcoin and where is the high? You know what I mean? That's the crazy thing, because some people think at the moment at $18,000, that's still very low for Bitcoin. And in the grand scale of things, in my humble opinion, I believe that is going to be very low when we look at the price of Bitcoin in 2 years' time. But that's just my humble opinion based on my last 4 years of analysis. I could be completely wrong, though. We could hit a double top and we've hit $20,000 twice and now we drop out of the air. But that's just my humble opinion. I just have to say really quickly, guys, and I know we've only got a small group here today. We're definitely going to be going over the 3-hour mark. I know that we had we've kind of touched and talked about a lot of different things. So based on a current projection, we're probably going to still be about another hour and a half. So by all means, if you do need to jump off though early, we totally understand this. It's all going to be recorded. You'll get sent to it. But if you want to stay with us, absolutely, we'll talk more. But being such a small group, we've kind of had the ability to do a lot of Q&As, which I hope you guys have benefited from anyway.
I'll probably have to drop off in about an hour or so.
Okay,
so
cool.
you know.
Well, we'll try and get as much as we can for you. So
I'll just stop asking questions. So
no, it's all good. It's all good. We'll try and get through it.
Thanks.
So another method is lending or borrowing. So this is more leaning towards the decentralized finance space. So we've mentioned before, you can be your own bank. And basically what this involves in terms of making profit is through these decentralized apps, or some of them are centralized, but through these apps, you now have the power to be either a lender or a borrower. And if like through a phone app, really. So you can lend your crypto out and earn an income from the transaction fees that are used for when people borrow from you. Likewise, you can also borrow crypto or fiat currency to use for whatever it is you need to do in the real world with that money, and then you pay interest on that, the same as you would with any other loan or anything like that. But there are ways to profit by borrowing as well, like in the same way that you can do in the real world, right? Like if you were to borrow, $500,000 from a bank and then build a set of apartments or something like that, and then sell that on the market for $1 million, then you pay the bank back their cut, and then you make your profit. It's the same thing in the digital world when it comes to crypto. And those three icons you see on the right, they're three different platforms that you can use. They're three platforms that I use in order to store my crypto and have some of it being borrowed, or lend some of it, and vice versa. It's just one other way. Like if you're kind of jumping on the hodling train and just going, I'm just going to buy some and let it sit in an account and wait for it to grow. Well, this is another way that you can let it sit in an account and possibly grow a bit more with interest and transaction fees. If you're not going to be an active trader or not touching things, the platform or the software can do that for you.
So just as we go through these next couple of slides, guys, think of yourself as a bank from now on. Like we said before, you are now your own bank. That's the best way to approach these next couple of slides, especially when we're talking about staking coins. The first time someone told me about staking coins, I honestly thought they were talking a completely different language. We're going to try and explain it the best way that we can here. But trust me when I say that if you don't get it after we explain it here today, it's not because you're thick. It's because we are talking a different language right now. For me, you might get it straight away. I'm very simple and it took me a while. So this is where the great thing is that it's going to be recorded, so you can watch it back a couple of times to get it.
Yeah. So with our bankers hats on, locking or staking is basically you buy coins and then you lock them or stake them for a period. So similar to like if you were to say get a term deposit with a bank, right? You leave your money with the bank and go, okay, I'll I'll leave it with you for 6 months and get a higher interest rate when I pull it out. It's the same thing, but you're doing it with crypto now. So like on this platform on Binance, you can do this method of profit generation where you lock up your coins for a certain period, and you can see there on the screen, like if you were locking up this coin Tomo, then you could get an estimated annual yield of 1 to 5% in interest growth on that particular coin. Whereas if you were doing ARK, which is another coin, then you could get 1 to 3%. So these are just estimations, but they're essentially better interest rates than what you get in a bank. So there are a lot of people that have moved to this way of high interest earning, and totally gone away from the traditional banking system. There are other platforms in the DeFi, decentralized finance space that you can earn, much larger proportions of interest, but then there's also more risk. So it's not uncommon to see, as you do more research in this, you might see something that's like, earn 300% per year or earn 1,000% per year. What you have to keep in mind when you see those things that kind of sound too good to be true and ridiculous numbers is the percentage of interest that you earn is directly proportionate to how many people are using the system and how many people are in the pool, essentially, of liquidity. So the more people join a pool, then the lower the interest rate becomes, because they've got to give out more rewards. The reason that these platforms are starting off really high with high rewards is because they want to get user adoption. They want to get more people into crypto, so they offer higher rewards for the people that jump in. Whereas if you find platforms like this, like Binance and Nexo and some of these other platforms that are somewhat trusted because they've been around for a while, they'll have more conservative levels of interest. They'll also be insured. Like Nexo has, I think, $100 million worth of insurance, and it's better than a bank, and still relatively safe, but not as like ridiculous as just like going to the casino. But it's in that.
It's less safe. It's much less safe than just holding your coins in a Trezor or in a Nano or something like that, right? You are still holding your coins on a liquid market. Like this one, for example, is Binance. So Binance is classed as the #1 cryptocurrency exchange in the world, and they have ridiculous amounts of safety. They have ridiculous amounts of insurance on their coins and all those things, but nothing's impenetrable, right? If something crazy, insane happened, it wouldn't matter if your coins are on a cold wallet. Something crazy could happen on the internet, and your coins are completely fine. If they're in somewhere else, it's that same thing, right? That we got this thing saying in crypto where it's not your keys, not your coins. Is that what it is? Not your keys, not your coins. That's what it is, isn't it?
If you're not holding custody of your private keys, you mentioned before with the wallets, then
they're not your coins.
Sorry,
Galen.
So what this means is that actually you're taking your coins out of your sort of safe space and you're putting it into
someone else's safe space.
Yeah. A trusted safe space. Like no different to when, instead of you keeping $50,000 of cash under your mattress or in your safe, right? Let's say you keep, that's probably a better way of saying you have $50,000 cash and you keep it in your safe, and you've got it in your safe. So it's super safe. It's impenetrable. No one can get to it. But as soon as you open that safe and you take that $50,000 out and you take it to a bank, because a bank says, hey, Linda, I'm going to give you 0.5% interest every year if you keep your $50,000 with us. We're just as safe as your safe at home.
Yeah.
Right. The thing is that, tell that to the Greeks in 2008 that got told that off their banks, right? And so it's the exact same thing. So there is still a level of risk, even though Binance is the #1 exchange in the world. They have ridiculous amounts of safety and everything else. There's a level of risk. There could be some crazy hack and attack on the Binance system that has hundreds and hundreds and hundreds of millions of dollars is lost, which is way above their insurance. What are the chances of that happening? Very, very, very little. But it's still more of a chance than if it's kept on your cold wallet, isn't it? There's no chance if it's on your cold wallet because you haven't given any risk that way. So it's all about that risk to reward ratio. Sorry, Kevin, I'll just really quickly say, I think your cord's playing up again. It's not showing up the whole screen again. It's just black. It's like, I don't know if you guys can see that, but it's kind of black. It's got a thick black line at the bottom of your screen.
I think it might be a memory thing. Is that?
Yeah, right. Okay.
Is that better now?
That's right. No, it's still the same, but when you change slides, it sometimes gets better. But I just thought I'd let you know. Yeah. I might have to share my slides maybe. Yeah, that's better. That's better. Yeah.
I think it might be automatically going into a like screensaver thing. But anyway, cool. Yeah, I'll just as an adjunct to what Troy said. So there is risk that an exchange could go down, which has happened before. But with the price of Bitcoin also going up, it's kind of it balances out in some scenarios or some cases. Like I'll give it an example. So with Mt. Gox, if you look up Mt. Gox, MTGOX, that was the biggest cryptocurrency exchange back in 2000, early 2014, 13, like early days. And what happened was in 2014, they were hacked and basically they lost 860,000 Bitcoins. And, that was a big shock to the market. They were the largest, exchange. And since then, they've had to go into this like recovery plan where on the 15th of December this year, so that's in like 3 days, they've worked out, I think they'll be able to recover about 140,000 of those 860,000 Bitcoin that were lost. So some people will still get some Bitcoin back. Even though they might not be getting the same amount of Bitcoin that they had back in 2014, even if you were to just get one Bitcoin back out of that whole stash, because the value of Bitcoin's gone up so much, they could still be looking at being on the upside dollar value wise. Does that make sense? Like they might have missed out, thousands or hundreds or whatever in Bitcoin, but in terms of the value, when you convert back to dollars, they could potentially make more money because of how high it's gone. So
that hack in the system happened in 2013, I believe, or 14.
Yeah, 13, 14, something like that.
So the security in these exchanges now are like a million times better. Like Binance's security is insane. So
two-factor authentication now and all that sort of thing. Which
massive levels of authentication and all other things. So the chances of it happening are very, very slim. But like what we said before, right? No different to your cash. If you had $50,000 cash in your safe, there's less chance of that disappearing than if you had it in the bank.
Yeah. Okay. So we're talking about staking, right? So the difference between, say, the Bitcoin model, which is proof of work, where computers race to mine the transactions and basically produce Bitcoin. With staking, so a model like what Ethereum is moving towards and what some of these alternate coins or altcoins are moving towards is simply staking their coins. So what that means is if they can show that they've got enough liquidity, like we've got enough gold bullion in a safe to show that we're worth what we say we are as a coin, then there's no necessity for the energy use of computational power and transactions and all that sort of thing that Bitcoin uses. So that's another model that basically precedes why these platforms like Binance and Nexo and other things are creating like a level for people to stake their coins, because if they can show that there's more users in the market providing liquidity, then it shows that they're a more stable platform or more stable protocol. And therefore can also generate more rewards.
So this is the part of the call that I was saying you're going to have to watch this back a couple of times if you've never heard this before. It took me ages to get my head around this. So like what Kevin just said, it's a way of the exchange, validating that they do have the liquidity there, right, to use. So this is kind of getting your banking hat on. So you are the bank, right? You're the bank who's helping this other bigger, can we call it a bigger bank? I'm not sure, to a bigger exchange, bigger financial institution. You're kind of like lending money to them to provide them liquidity for all their exchanges that are happening in their pools. And so we might actually, I have actually come across a good YouTube video on this as well, which really explains it as well. So I might try and find that again and send through a link of it. But this is something where you'll need to watch the recording, and you'll need to go back and watch this a few times. We could probably create an 8-hour video on staking alone that will have your mind exploding by the end of it. But we did want to include it in this so you're aware of what it is.
Yeah, there's also a module on DeFi that we did in the morning class that I'll cut into this video as well in the replay.
Yeah.
Watch it.
Yeah.
So moving on, the next level of making profit is obviously just investing. People are familiar with IPOs, right? Like initial public offerings when a company like Amazon
or stock market,
goes onto the market. In the crypto world, they do the same thing. So there's the ICO, which is like initial coin offering. That's where a company will say, hey, we've created all these coins, and if you're the first to buy in, it's a fundraising method. If you're the first to buy in, you could buy the coin at 50 cents, but when we go to market, we'll sell the coin at $1. So you're already kind of getting your investment return there.
But to give you an idea, sorry, Kev, I'll just really quickly say Binance, who we just spoke about before, which is pretty much the #1 exchange, cryptocurrency exchange in the world as of now, December 2020. In July 2016, they had their ICO where people could invest in their company. And at the time, it was just an idea, right? And then they grew in 4 years to the biggest exchange in the world. So it's no different to Amazon, Apple, Tesla, whatever it is, right? They all started as an IPO and an idea where people had to invest in it and get big. A really great recent example is Uber. All right, Uber was a startup, and it started up as this idea, and people got into the private sale and the IPO and things like that. And then it obviously look what's happened. It's absolutely boomed. So the exact same things happening in the crypto space.
Yeah. So instead of having a share certificate, you basically have the coin. It's a digital version. Another version of that was the STO, which is a security token offering, and that basically was based around regulations to do with companies offering securities. Because what happened in this space was you had a lot of these startups sort of like hyping things up and going, yeah, we're going to the moon, we're going to be $1 billion company, whatever, and then it turns out to be a scam, or things tank. So STOs were sort of put into place as well to try and mitigate that risk for non-accredited investors. And so what's been born out of that whole sort of roller coaster up and down, because a lot of people did lose money backing the wrong horse, so to speak, losing companies. Now there's an IEO, which is an initial exchange offering. And what that basically does is it uses the brand value or the brand power of someone like, say, Binance, being a well-known exchange. If they say, hey, next week we're listing Linda Coin, right? As a consumer, you might go, oh, okay, that might be something worth buying into, because Binance would have done their checks and balances and gone through the regulatory processes to approve Linda Coin to be listed on their exchange. Whereas if you just heard about Linda Coin from Bob down the road who said, oh, this next thing is going to the moon, that's equivalent to like someone running a GoFundMe campaign or a Kickstarter campaign or something where it might work, it might not, but it doesn't have the backing of a big exchange listing it on their platform. So that's also ways to invest in that. You could find coins. Usually what happens before, when it was the ICO sort of world, you had these schemes called pump and dumps, right? People would hype up the news that, Linda Coin's about to jump on the exchange. So everyone buys. And then once it's listed on the exchange, they just sell and dump it. And it's like a pump and dump. Whereas IEOs kind of mitigate that risk, but there is still a bit of a pump, because if you hear, okay, Binance is going to list Linda Coin, then there might be more people buying, but then you usually ebbs out a little bit, a little bit better. So it's just different levels, I guess, of investment risk.
It all started from the regulatory processes, right? Because you guys may already know, America, for example, you got to be an accredited investor to in certain things. You got to prove, I think it's 50,000 it is. Where an IC who got into the Binance got $100 or something, right? They could have bought $100 worth of the Binance coin. You know, in the old school world, as an accredited investor, you had to have a certain amount of money and do a certain amount of money. And that's where, in one way, I think we described it on this morning session as the Wild West. And, you know, it was just crazy. You know, people were pumping and dumping things, and it was out of control. And they thought they had to bring in some regulatory standard to fix that.
Yep.
Your screen is going black, Kev. So not sure.
Is that better? I'm up to NFT.
Yeah, that's better.
That's better. NFT. Okay, I'll continue.
Yeah,
so
NFTs. Yeah.
Another way.
So once again, guys, if you don't get NFTs, yeah, sorry, I was just saying, if you don't get NFTs, like, don't stress. This took me a while to get my head around this.
Just kind of showing you know, the menu available. Just so you have a picture. So NFTs are basically, they're called non-fungible tokens, and they're just tokens that cannot be copied. So they're original versions. And so the way to think about it is like through collectibles or art or trading cards and you know, game items. The popular sort of thing that started happening was, say, an example like CryptoKitties, right? Do you remember Tamagotchi or Pokemon or any of that sort of stuff, collecting baseball cards and whatever? Some people were able to create these collectibles where they had unique properties, like, you know, you could only have X amount of the blue cat with the purple spots, or there's only one cat with the yellow stripes and the red dot or whatever. And each of those were worth a different amount of a cryptocurrency. And it caught on so much, like similar to other fads like Beanie Babies or Tamagotchi or Pokemon, whatever, where people started paying real money to, you know, collect these crypto kitties. I think there was one that was like almost $250,000, maybe more, maybe less. And then that's kind of moved into this concept of virtual real estate, where you can buy plots of virtual land around the world through particular platforms where you can, you know, earn crypto as well, and then convert that to cash. If you've heard of like Sims or Second Life and that kind of, you know, virtual world kind of space, that's where it's being used in also in games. So one example is like, say, a Dungeons and Dragons type game where you're running around and you have to dig through a cave and then defeat the dragon to get the, you know, special magical sword that's at level 99 in power or something like that. That might take you 10 days worth of gaming to do. But for someone who just wants to get ahead in the game, they might be willing to like pay you for your time to go, hey, look, I don't want to bother going through this particular dungeon. I'll give you $100 to just give me that magical sword. So there are people who go and do that in you know, digital money, digital cash, but then end up converting it back to real money. And there are people who basically do it for a job as well. They'll just game to actually collect these items on behalf of other people and sell it on the marketplace, similar to eBay, because, you know, they're saving people time or giving them something that they didn't have before. So it's more of a novelty, but it is actually quite valuable. And
There's a huge market for this, guys, just so you know. So the space in artificial intelligence, the space in virtual reality, augmented reality. This is just the future of the world, and what this is doing is just incorporating a currency into that future. So as crazy as this may sound to some people on this, you know, and I can verify this from future generations. my kids are like obsessed with virtual reality, and they're obsessed with, you know, all that kind of thing, because it's the norm to them. Whereas us growing up, that, like, what the hell, like it's a Star Trek episode, the kind of stuff that's happening, right? And what's happening here is there's cryptos that are applying and capitalizing on this and applying currency to these things, where you know, you can, companies and these products, you know, are profiting massively from this market. This, we just wanted to give you guys an example. It might not apply to you guys in particular, but this market is massive. Like, I'll give you another really quick summary on this. So what's called as esports, right? So video gaming, essentially. So playing video game sports. It's actually, this is pre-COVID, before all the crazy lockdowns happened, but people buying tickets to go to a stadium to watch kids play video games in America and play esports on massive screens. It was outselling the NFL. Okay, so this is the kind of thing that future generations are obsessed with. They're obsessed. There's gamers online who make millions and millions and millions of dollars just by streaming themselves playing games, and they're profiting by these, you know, these adding these tokens to their games and things like that. This is just the crazy world that we're living in, with the connection and that real connection that the younger generations have to the internet. This is inevitable, what is happening and occurring.
Like, so a whole business strategy could be around, you know, if you have children, or you just start priming them for this so that they can create future wealth and NFTs and
you know, the crazy thing is that's 100% true, right? I've got a 10-year-old who wants to create a YouTube channel, right? And I'm setting up a YouTube channel for him, safely, of course, but he wants to stream his games. He plays certain different games, and he wants to stream them. He wants to start up a Twitch channel and stream. It's just the way that, you know, it's just the connection to the internet that these kids have grown up with that we didn't have.
So I don't really understand the connection between the gaming and the actual revenue. Like, what is, other than people going to watch them in a stadium, but how are these people making money? Like, how would a 10-year-old with a YouTube channel, and what's the connection with crypto?
Do you want me to take
that? Oh, sorry, Kev, do you want to go?
Yeah, I was just going to say, well, the basic form is advertising. So, like, say on a platform like Twitch or YouTube, you know, there'd be companies paying for ad space. If someone is drawing attention, because you got to think about it this way, right? Like, influencers online, kids online playing, they're trying to get people's attention, to watch them. And so the advertisers will jump on and go, okay, if there's eyes on this particular gamer, then let's buy some of that ad space. And then the company like YouTube would pay a dividend of that, you know, payment to the person who's getting more subscribers or getting more views and all that sort of thing. So with something like YouTube, as soon as you have 1,000 subscribers and a certain amount of views, you can start getting paid. That's just like normal cash money. Whereas in the cryptocurrency world, you know, games are coming up with their own currencies within the game itself that people can convert back to cash, or they can convert it to items and buy and sell in that regard. So companies like, say, if you're playing an F1 racing game, right? Before, the model in advertising was, when you're racing cars, there'd be billboards on the side of the road, and, you know, Goodyear would pay to have that spot, and Michelin and whatever else. And then now, similar to what Troy was saying about the tickets, you can actually purchase a virtual version of the F1 car. And, you know, if that wins or that gets certain sponsorship with advertising, that's all paid out in a cryptocurrency that you can then generate income from as well.
And because of its an NFT, it's non-replicable, so it's a scarce model of it, and you can't just copy it.
Yeah. Exactly right. And like, you can have certain tweaks, right? So that F1 race could have been the Austrian race, and therefore in the Austrian race, that NFT has the Austrian flag, and there was only ever one of them created, right? I know this probably seems so foreign and crazy, but it's no different to if you could refer it back to rare baseball cards or rare basketball cards or certain football cards that had a certain name or a certain badge on it or whatever that we had growing up. You remember there was a certain football card that I had where there was only 100 of them produced. So those cards were very valuable. This is all these are virtual baseball cards, virtual basketball cards, virtual football cards. That's what these things are. It's just in a virtual world.
So any of these kids could be creating whatever they want and selling them, and that's actually how they're making the money.
Yeah, there's platforms as well for these things, like that you can buy these things off. And there's also platforms like if you look up Rareable, maybe I'll add that to the list of links as well. Rareable is like a digital art platform where someone will produce a piece of digital art and it will have a certain value, and the NFT attached to it means that if you buy it, if you purchase it, then it's accredited that that's from that particular artist or that particular series. It's worth this much. You can even go down to like what's called fractional ownership, where say all 5 of us really wanted a Picasso or a Da Vinci painting or something like that. If that was digitized, we could say, okay, let's each pay a fraction of that to own a portion of it, just that little corner of a Mona Lisa or something like that. And if that sells on the market, then we have a chance to earn from that as well. There's a really interesting project. I can't remember the name of it because it's just new. But
Concrete, the one with the concrete with the real estate.
No. Brick X. Well, that's
you
it.
Can own a brick of a building,
brick by brick, and just own a certain portion. I was thinking of the other one that this arts group basically released 12 NFTs. So they're 12 individual pieces of digital art, and it's a smart contract basically that's displayed visually. If you imagine this, right? We talked about smart contracts before, that you can attach assets to it. So you've got this digital painting. Behind it is this smart contract, and wrapped up in that smart contract, one of these 12 pieces of art has a Bitcoin, right? And the whole experiment is, if they hand it to these 12 different people or whoever buys them, if you unwrap the art to try and find the Bitcoin, if you have the Bitcoin in your piece of art, then you obviously have one Bitcoin and everything's great for you. But the other 11 pieces of art lose value because they don't contain a Bitcoin, so they just drop straight to zero. Or the option is you don't unwrap the art and just bank on the fact that you might have the piece that has the golden ticket. You might have the art piece that has the Bitcoin, and so long as nobody unwraps their art, the demand and the price starts going up because people want to pay more for trying to collect the whole set or trying to accumulate more, thinking that they'll have the Bitcoin and just hold on to it for years. And so all the value goes up of every single piece versus the one person just, trying to be greedy or something like that. So it's a really interesting experiment in art, in technology, in human greed and fear. And, the whole time that this is happening, it's all just raising in value because it's all just being processed digitally, I guess, by computers. So
we could go down the rabbit hole. And
I'm like that's a rabbit hole.
We're going down a rabbit hole. It's some great questions you guys had, but we're gonna me and Kev get into full nerd mode, so we're we're conscious of that. So we're gonna now move on.
Okay. Yeah. So another way that you can profit from it, and this is like the second last sort of method, is through getting paid in Bitcoin. So that first link that you see there, get paid in Bitcoin, is actually a website, getpaidinbitcoin.com or .com.au. I know in Australia, you can ask your employer, you can basically register on this site, and then they give you the proper forms and all that sort of thing. You give them to your employer, and they can allocate 20% of your salary to be paid in Bitcoin. Bitwage is similar as well. Bitwage is more universal. So for anyone that's overseas, it's the same principle. You basically fill out all the proper forms for tax and payroll and all that sort of thing, and get paid a portion in crypto. BitPay is somewhere in between, where if you also run a business, it allows you to accept crypto, but on the front end for the customer, they pay in fiat currency, but then it converts it to crypto for you. So then, you know, if you're a sole trader or a freelancer or contractor, you could basically invoice your customer, and they pay in cash, but the company ends up paying you in crypto. So you can, you know, build up your stash there as well. And then DeFi, we touched on that already. I'll skip through this part because I'll just copy and paste the module that we did with Paul Holland, who was on this morning's session, but he goes into DeFi a little bit more. So I'll skip this part.
Yeah, that'll come out as a video for you guys. And because we've kind of gone down the rabbit hole of a few things now, we don't want you to hear the rabbit hole of DeFi right now, because we've gone nearly 3 hours, and we're totally we understand that, and that's probably how you're feeling. That's probably how you're feeling, especially after that staking slide. But yes, so like I said, guys, we are at the 3 hour mark. We're going to actually try and get this done within the next kind of half an hour. So that helps you as well, Linda. We don't want you to miss anything live. But yeah, does anyone happy to do either way? Would anyone like to take like a 2-minute break to grab a water or a quick toilet break or anything? Or are we cool just to keep going through?
Yep. I'll try and
good.
this.
You're good, Clive, to keep going, mate? Yep. Okay, cool. All right.